Hi, everybody. It's Jeff Barton for the Mortgage Minute. Thanks very much. Fed raised the rates today by 25 basis points. What's that mean? Probably means that inflation is more under control than they think, and they don't want to stall the economy into a very bad recession. I'm thinking we're probably going to have some kind of recession later in the year. But for now, it looks as if the economy is still pretty strong. Jobless report, I think we're going to have adding about 168,000 to payroll. We did see non-farm payrolls come in a lot lower than expected, but that was probably because of the bad weather here in California, and the rest of the nation faced a lot of snow in December, and a lot of people just didn't get out there to get hired. I do have some family members trying to get work, so I do know what that's like. But there are now back over 11 million jobs available that are going unfilled. That's something that we continue to look at when we're looking at wage inflation pressures. That's really what's, as I said earlier in the radio show today, that we're looking at 7.5% increase in wages from last year at this time to this year at this time. That's inflation, and that continues. Let's get right to it. We have a 30-year fixed rate loan at 6.21, 15-year at 5.27. We have the FHA loan at 5.78%, 5.70 for the jumbo, and 6.27 for the 5/1 ARM. The 2-year and the 10-year continue to be far apart, about 0.8 of a point. 10-year coming in at 3.54. That dreaded inversion of the yield curve, which is what this is, really looks at us being in a recession. And as I said earlier, yeah, looks like probably for the late second, early third quarter. That's what I'm looking at. Let's see some other things. Okay, so when we're looking at the Fed, and as we said, the Fed is lowering, raising the short-term interest rate member banks pay by 25 basis points. They're looking for steady and consistent when it comes to what they're trying to do in order to cool the economy, but yet still maintain some momentum to continue to have, obviously, no recession. So what does that equal, slow and steady, or steady and consistent? It's stability. What is stability in the markets? Okay, so from mid-November to January of 2023, the rates between 6 and 6.5% for the 30-year fix. That's consistent, and it's down about a point from the high end of where it was at the end of last year. Refi apps are rising. That's consistent. We want to continue to see that happening. And I think if we get rates down into 5.5%, we're probably going to get that. Purchase apps, the trend line is up, meaning that people are thinking that, yes, looks like I'm going to maintain my job. Yes, looks like prices have stabilized. And yes, it looks like the interest rates have also stabilized. So that in turn leads buyers back to the market. That's something to continue to watch, and we'll do that on the show. Housing affordability, 90% of all buyers cannot afford half the homes for sale in the U.S. market. That's not a good thing. Affordability has been a problem for more than just during COVID. It's been a problem for the last 5 to 10 years. Not building enough houses, not enough units out there, and the baby boomers are living longer, so their particular houses are staying occupied. Let's see, what else is happening? Rents are down. Inflation is also somewhat down. But the main thing to look for here is the change in the money supply. The change in the money supply, i.e., what's sucking the money out of the system, and how is that going to affect inflation overall? We are seeing that the Fed has obviously stopped mortgage-backed security purchases, stopped bond purchases, and that was about 6-7 months ago. But also that the Fed has stopped reinvesting and are offloading some of its balance sheet. Both of these things take money out of the system. That means money is more expensive, which means it will also cool the economy rather than just raising rates. Another thing to look at. Active inventory this week up 69% year over year. However, it is down for new listings 5% year over year. Closing price gains fell to 7.7% annual gain from 9.3%. What that means is this year, if you compare it to last year, your house went up 7.7%. However, that particular gain, which is good, falling from 9.3%, which it was just 3 months ago. So we see that housing prices are coming down, even though immediately right now they are continuing to go up, which for those people who are using their house as equity by which they can live on, or by some way by which they can take advantage of the equity in their home, either by a second or a refinance, yes, it's still a good thing. Let's see. D.R. Horton, the net order price continued to decline 10%. Let's see, a couple other things. All right, we're at 5 minutes. It goes fast. Anyway, I'm Jeff Barton. This is the Mortgage Minute. We'll see you next time.